Heading into the Friday, August 1st job report and latest tariff deadline, implied volatility was trading significantly higher than realized volatility, an indication that the options market was pricing in more price movement in the future than the markets had experienced in the last several weeks. Following that employment report, which reflected a weaker than expected domestic labor market, U.S. equity prices sold off sharply and Treasury yields declined on Friday. Additionally, according to CME's FedWatch tool, the probability of a cut to the Fed funds target rate at the September meeting has increased from 63% a week ago to around 90% today, and the chance of 3 rate cuts by the end of 2025 has risen to about 50%. On Monday, however, stock prices rebounded and implied volatility in both the E-mini NASDAQ 100 and S&P 500 fell after spiking on Friday. But when we look at the skew using the 25 delta strikes, particularly in the NASDAQ 100, the puts continue to trade at a premium relative to the calls versus the last month as the options market continues to price in potential further downside moves. Looking ahead, mid-month brings the release of key economic data, including CPI, PPI, and retail sales. Later in August, the Jackson Hole Economic Symposium is scheduled for August 21st through the 23rd, followed by NVIDIA's earnings on August 27th. The month concludes with the July PCE report on August 29th, which is widely considered the Federal Reserve's preferred measure of inflation. CME offers several different products for traders wishing to gain exposure to the major U.S. equity indexes, including E-mini and micro E-mini futures. And for options traders looking to capitalize on changes not only in price, but in volatility of those indexes, CME has options on both of those futures contracts.